Bear with me here. Just gonna shut off the YouTube here. All right, we are live. Thank you everybody for tuning in. I don't know why I always feel like I'm in such a rush. Forever I'm sitting here and I'm waiting to go live, and then for some reason, right towards the end, I feel like I've forgot 17 different things. So I always feel a little bit frantic going live, but hopefully everybody's got their coffee ready to talk volatility ETPs, all kinds of fun stuff. So we've got probably quite a bit to get to. Here's a rundown of what I'm expecting to talk about. Of course, depending on the time, sometimes I can rant, sometimes I go off on tangents. So depending on what we get to, but this is kind of what I'm thinking. So first of all, we'll do volatility stuff. You're all here for trading, and most of you, maybe some of you do, but most of you are here for that. Maybe you care about my opinions on the world a little bit, but let's start with that. And I thought it would be fun to go through some data and try to actually anticipate when the next volatility ETP reverse split will actually be. Because it's not necessarily about nailing down the actual date. Of course, that doesn't matter. But in figuring out how we know when it's likely to be, there's actually some pretty important data along the way that people might be interested to see. You know, trends and decay factors and all that stuff. So we'll get into that, and I think people will like it. So right now in your own head, as you're just preparing, for all of you who know what UVXY and VXX are, when do you anticipate the next reverse split to be? Based on how you think it decays over time, ballpark figure, and then we'll actually go through the numbers and you can see how close you were. That second point, I don't know. We'll see. I've got a lot of thoughts on this recently, and I thought I might go off on a little bit of a rant. People are used to me ranting on certain things. I might actually go off on a little bit of a psychology rant about, you know, the state of the world as we know it. So we'll see about that. Hopefully that'll be quick. And then open Q&A after that. I think a lot of people are here for that. They like to get their questions in, and I'm more than willing to ask any questions. So you can, you know, ask me stuff on Twitter if you're following me there. I can give you my handle @VolatilityVix. You can leave comments in the YouTube channel. After every video, you can ask questions. I do respond to comments there. And of course, live streams. That's kind of what everybody's here for, the Q&A. So we will get to that, and I'll definitely leave plenty of time. But let's get into it with a quick little intro, and then we'll just jump right into the VXX and UVXY. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so thank you again for everybody showing up. This is Volatility Barometer episode 20, I believe, and there will be many more. One thing I want to point out, I do have an air conditioning unit, and I'm wondering if I should actually turn it on. But somewhere midstream, I might be able to turn it on. I'm in this new place now. You can see the very boring background here. Unfortunately, sometimes you get a great view. Sometimes there's nothing available. But I'll be here for a little while. So I actually want to turn this on. Bear with me. And just see for maybe 5 minutes if the sound is too annoying, because this place does get pretty hot. So I'll turn it off in 5 minutes, but I just want to have a basis for comparison, and we'll see how that sounds. But let's get into the volatility stuff. So like I said, this isn't necessarily about nailing down the exact date. This is much more about the data required and the understanding to actually figure these types of things out. Whether we get the date, dead on correct down to the same month, or whether we're wildly off, it's really unimportant. But there's a few things that we need to know with these volatility ETPs in order to actually nail that down. So let me see if I'm on a screen share. Good to go. This right here, well, actually we should look at the VXX. This is the VXX 1x long volatility ETP since its live inception, January 29th, 2009. This is what it looks like. Now, this is not a log scale. It looks awful. So we can look at a log scale here. This is much more, you're able to gauge what it's doing over time. This is live trading. Now, this is, of course, split adjusted. The price was never $400,000, but it's gone through so many reverse splits along the way that if you adjust for that going back in time, it actually started at 400,000 and it's down to, less right now. This isn't updated the last month or two. Right now, it's in the 20s. So the first thing, and this is a little side tangent before we get into nailing down when this thing is going to do another one of these 1-to-4 splits, and we will get into UVXY in a second. I'll do that one as well. But one thing that I want to point out, this is something that's often misconstrued with some of my videos, articles, live streams. I'm never trying to talk people out of shorting volatility. I personally believe that everybody out there, all investors, should have a small percentage of their portfolio in some version of a short vol strategy, whether that be 10% for the hyper conservative, 30 to 40% for the ultra aggressive, somewhere in between for most of the rest of us. What I do discourage people against is the method that they short volatility and how they go about it. That's the difference. So you might hear me say negative things. For example, something that I'm always ranting about is the dangers of non-defined risk spreads, like naked options, for example. I will always fight to the death on this subject, that it is just a terrible idea from both an efficiency standpoint, that you'll actually, even though it looks like you'll make more money doing it undefined, you'll actually make less in the long run, so it's just inefficient. But it's also one of those trades that creeps up on you and people misinterpret how badly it can go. They think, well, I understand the price can spike up and I have a plan to take care of that. What they don't understand is that several factors start to add up. The Vega factor of the trade, for example, being a short Vega trade, when volatility spikes, it amplifies your problem. And it's no longer price, it's Vega and price now, and you're getting really hammered. And then your buying power dries up because you're losing money over time. And then brokers will come in and change margin requirements, and now you got hit again. And it can go so badly that I just discourage people from that. The other thing that I always remind people, this is something you'll hear often on Twitter and people talking about it, they always think volatility ETPs just go down. They just decay, right? Obviously we can see it. We can see it in a chart. People say, duh, just short this and you'll make a bunch of money. Obviously, it always goes down. And if it doesn't go down, sure, we can see a few spikes here and there, but all you really have to do is roll it out, and eventually it'll go down and you'll make your money back. You hear this said quite often. While it's not necessarily untrue on a very long time horizon, I do want to point out on this chart, as you can see, it is possible for volatility ETPs on a strictly buy and hold basis to not return to previous values for years on end. I mean, we can see a period here, this spike here, December 2009, is the same price it was at in December 2008. 4 full years, a buy and hold investor would have made money, then lost money, made money, lost money, made money, lost money. Flat for a while, made money, lost a bunch of money, flat for a while, made money. But for 4 years straight on a buy and hold basis, you can't just roll it out because it might take years. And of course, you're burning capital. Another period that happened is recently here. You can see in 2017, it was actually lower than it was in June of 2020. This idea that volatility always goes down because people flash charts that look like this, Of course, this sells really well on Twitter. This looks awesome. All you do is just short vol with both hands and money falls from the sky. That's an easy sell, and you can get tens of thousands of followers on Twitter by just pointing out the rather obvious fact that volatility ETPs decay, and you can make money doing it. But translating this into a profitable strategy is far easier said than done. So that's all I wanted to point out in this side rant. One thing you might find interesting before we get on to the actual reverse split stuff is, what do you think the rate of return of a rolling daily position in short VXX is for the last, I'm just checking if I'm on screen share, for the last 3.5 years? What do you think this period looks like? Because on this chart, it looks like it should have been slightly profitable, right? Looks like shorting vol, while it would have been painful and diabolical 3 or 4 different times in the last 3.5 years, it looks like if you just held a constant short position, eventually you would have recovered your money, right? People watching, is that what you think? That basically you just have to hang on and just keep rolling, and eventually you'll recover, right? Would it surprise you to know that this is what it actually looks like on a daily rolling short VXX position? It's down 80% in the last 3.5 years. This is what rolling short vol actually looks like. This chart is just what people flash on Twitter to get people to follow them, because this looks like you just short it and make money no problem. The reality of the world that we live in, investment results are compounded geometrically, and this is what short vol looks like for the last 3.5 years. An annual 1-year annualized return of minus 34% per year. This is what it looks like in an actual practical application. So I just wanted to point that out, and it looks far, far worse for a period like this. So while, yes, you could say there was a golden year of short vol that lasted about 6 years, there's also bookend marks here of 4 years here and 3.5 years here, where in a practical trading sense, it looks absolutely miserable. So don't forget that as well, that anybody who's just doing that, they're just pulling on emotional strings. They're just trying to get you to follow them and do things that are probably not advisable. But short vol is definitely a much more difficult trade than people lead on. The last 3.5 years is evidence of that. But anyway, let's try to predict, first of all, VXX, and then we'll go to UVXY. When will the next reverse split be? We really only need a few data points of information here. So the first point we need, forgive me, this is just one of many spreadsheets, but I do compile quite a bit of data. This one. Here's the VXX split history since it launched in 2009. So it's done 6 reverse splits, all of them 1 to 4. So basically, if we just take an average of when this typically happens, we can see that it happens at a price on average of $11. Now that's kind of biased a little bit because there's a couple of them that look quite high, that they reverse split at 13 and 1284. That's not actually what happened. What's happening there is between the time frame that they announced the reverse split to the time that it actually executed, the price spiked up. But they probably announced it when it was about 10 or below. I can actually show you. So November 9th, 2010. We can actually just see what happened on November 9th, 2010. And this will just demonstrate that it's not always on an even, like, it splits at 10 every time. That's not actually how it happens. But what was happening on November 9th, 2010? Somewhere around here. November 2010. So this is the week of November 9th. So you can see what probably happened is they announced the reverse split when the VXX would certainly have been low because the SPX is doing well. And then in the time being, in those couple of weeks, you can see in this week of the 15th of November, 12th of November, going back probably to the 5th, it actually probably spiked up. So a little bit deceiving. I'm going to go ahead and say it splits at $10. We're just going to round number, make this really, really easy. The next reverse split will be when the VXX hits $10. That's our assumption. The next piece of information we need is how fast does this thing actually decay? And for that, we can actually just plot it on a long-term chart, and we can see that while sometimes it goes down strongly, sometimes it spikes violently, and sometimes you go through a 4-year period where it doesn't do anything, in general, long-term, average, it decays 0.23% per day. If you want to go, sorry, my spreadsheet's taking a while to upload. See that beach ball action? That's Excel on a MacBook. It's not ideal. Here's a 5-day decay, 1.186%. If you want to know on a 21-day, basically monthly, 21 trading days, 4.887 per month, long-term average. So now we can take those two pieces of data, it reverse splits at 10, and it decays this fast. Now we can actually just put numbers to it. So this is something that all we have to do is input what the VXX is today, 2628. 2628. And it decays 0.238% a day. I'm going to update this. One little side tip for people. You should probably turn off your auto calculate in your spreadsheets. And it takes 5 seconds. It just beach balls, and then eventually it'll kick in and show the actual data. But it means you can have a much larger spreadsheet and it's still functional. Anyway, now let's see when $10 is. When is this actually going to happen? So it's going to breach below 10, 406 trading days from today. So easier probably to go monthly, 19 months plus 7 trading days. So 19 months plus 7 trading days from now, we are expecting the VXX to be $10, right about there. So what would that be? Right now it is August 14th. So 1 year, we're looking at 2023, 17 months. Was that 17 or 19? I want to get the numbers right here. When did it breach below 10? 19 months. So add 7 more, that gets us to March. So March 14th, and then we're going to add 7 trading days to that. 5, 6, 7. 24th of March, 2023. So let's write that down. VX, come on, spreadsheet. Sorry, guys. My spreadsheet is behaving very poorly today. You can see this. VXX at 10 on March 24th, 2023. That's when we're expecting, based on long-term decay factors, that the VXX will once again do another one of its famous 1-to-4 reverse splits. So this number, 402,000 at launch, extrapolated backwards, sometime around mid-2023, this will start to say 1.6 million because it's going to do a 1-to-4 reverse split. And then the VXX is going to go back up to about $40, and the whole process starts again. So that's for the VXX. Now I realize that UVXY is sometimes quite a popular product. So let's do that one next. Here's the split history for UVXY. And let me just double check for everybody that I'm on a screen share. We're good to go. I hate talking for 5 minutes and then realizing you're just staring at my dumb face. So here we go. UVXY is a little bit different. They split at different speeds. So UVXY history, we're just going to use the average. 7.13 is typically when it splits. So if it gets below 10, they'll probably start eyeing it. You can see this one at 1548. Very likely it was the same situation where the 2-week period between them announcing it and the actual split price, something happened and the UVXY spiked up. But let's use 7.13. That was the one. UVXY is a little bit different because now, come on, spreadsheet. You're ruining my live stream. Come on, Excel. This is just bad content with a spreadsheet that doesn't work. UVXY is a little bit different because this is a leveraged product. UVXY nowadays, on February 27th, 2018, because of the Volpocalypse stuff, they actually deleveraged from a 2 times product to now a 1.5 times product. And this is all adjusted for 1.5 times. So this isn't, in 2018, I changed the system. I actually went through the numbers and corrected it all going backwards as if it was 1.5 the entire way. That's what this is showing. If we want to see what it used to be, we could use the old TVIX for that because that was 2 times. 2.5 billion to $112. Pretty insane. Here's UVXY at a 1.5 times leverage factor. I haven't adjusted this for the split yet, but this would be 17 million. Down to what it currently is, about $23. Again, flash this on Twitter and everybody's going to have this idea in their head that all you do is short it and everything's great. Well, not so fast, because this period would have probably lost 80 to 90%. Remember, losses are more costly to a fund than gains are beneficial. So whenever you take massive catastrophic losses, it takes hundreds of percent return after that just to get back to the break-even point. That's why short VXX looks like this, and short UVXY would look far worse than this, because those down periods are so costly to a fund that a rolling short vol position is basically suicide. I mean, even in good times, I mean, the market is up in the last 3.5 years. Even in good times, you could lose 80% of your money doing that. So some people don't understand the math involved there. The simplest example is the old, if you make 50% this year and lose 50% next year, are you back to break even? No, right? You're down 25%. Start with 10 grand. Make 50%, now you're at 15,000. Compound geometrically, now you lose 50%. Your 15 goes to 7,500, and you're not back to break even, are you? You've lost actually 25% of your money. So arithmetically, and on Twitter, flashing the right charts, it makes it appear like all you do is just do this in short vol. Geometrically, compounding the way that the real world works, very, very far from the truth. But anyway, 7.13 for a UVXY decay factor of 0.423 per day. So you can see it's a little bit more than the VXX because it is decaying at a 1.5 times leverage. On a weekly basis, it decays 2.1% per week. On a monthly, 21 trading day, 8.5% a month. That's how much long-term a 1.5 times UVXY would decay. Pretty significant. But again, of course, it can spike up hundreds or even thousands of percent in a single month. I mean, it spiked up something like 1,500% in a 3-week period not that long ago. So obviously factor in that it's many, many months of easy wins and then a few mixed in catastrophic losses. That's why people get in trouble. But when is the UVXY going to split? So we already have the VXX, and I'm going to keep this on my actual spreadsheet, and we're going to come back in about a year and see how close we got to it. But what's the VXX trading, or the UVXY trading at? I think 23 something, 2302. So let's do the same calculation, 2302. The only thing I have to change is now we're using UVXY decay factor instead. So a little bit faster, 1.5 times leverage. Activate my calculate, watch my spreadsheet beach ball for a second, and then it's probably going to be much quicker than the, what did we say, 19 months and 7 days for the VXX. When is it going to go down to 7.13? That would be 277 trading days from now. So 13 months plus 4 days. So that would put us again in 2023. It'll be down somewhere around here, plus a month, plus 4 trading days. So that is going to be September 19th, 2023. UVXY will be at 7.13 on September, 19, 2023. There we go. So this is the decay factor of the expected path of UVXY. Now you can see when I'm very frustrated with this spreadsheet. I have no idea what's going on. It's probably because I have a few web pages open and it's just my computer's not liking what I'm doing here. But you can see that it's not actually a consistent pattern, right? I'm not actually expecting it to be nailed right down to that date. But what we're really looking at here is the average decay factor. So maybe we go in a very long extended period of good volatility, good short vol trend, and this happens within 6 months. That could happen. Could also see another spike, could see a recession, could be 3 years from now, 4 years from now. Like I said, volatility doesn't always just go down. That's a completely inadequate way to look at the volatility market. Yes, on a 20-year time horizon, but you can get caught for multiple years losing 80 to 90% of your capital thinking, isn't this thing always just supposed to go down? Well, not really. Remember geometric compounding. It's that little detail that those Twitter accounts that fail to mention. You can get tens of thousands of followers online by omitting just a few important facts about the reality of how difficult it is to trade volatility. Nobody who actually manages capital in the real world, nobody who manages a tail risk fund, nobody who manages actual client money, if they're an RIA, anybody who's a legit investor in the world, they never say that shorting vol or vol of any kind is easy. They will never say that because they know how difficult it is. But if you're on Twitter and you don't have clients to answer to, you don't ever have to show your results online, you just talk. For some reason, there's millions of people out there that just think it's money falls from the sky. Well, manage one client's capital and then with a straight face tell them that it's easy money. The reality is, the factor that changes is, are you responsible for results or are you responsible to gain followers? These are two wildly different motivations here. So hopefully people understand that this is a tough game to play, but with enough data, if you start to understand how these things decay, if you start to understand that, look, we are talking about a product that, while it is complicated, it's also kind of simple at the same time. It really is just a accounting of where these front 2-month VIX futures are in relation to the spot VIX index and how those move over time. It could be that simple, but it could also be very complicated. So one thing that you can do is just, I'm wrapping this whole section up here, is you can go to my videos on the YouTube channel. If you didn't check it out, check out this one called What is Contango? This is part 1 of a series that'll probably run at least 30 or 40 parts. I'm just going to break down concepts and introduce them. Hopefully 3 to 5 minute videos. We'll see. I tend to ramble, but this one was a little bit longer because there was important data that I was talking about. But yeah, watch this video. It's not actually that complicated how volatility ETPs work, but it's very complicated to turn that into a profitable trading strategy. So where was everybody on their guess? Before we went into that, I asked you when, how long, ballpark is this thing going to go? How close were you? What did we say? VXX 19 months and 7 days, and UVXY was 13 months and 4 days. 2023, early to mid, seems to be about the proper decay factor for when we will have to do some streams on what do reverse splits mean? Should you exit your option positions? We did a whole bunch of those before. Unfortunately, people got caught and they didn't understand. But next time I will prepare everybody just like we did last time, and we'll be good to go. All right, I'm going to look at the comments. Doesn't seem to be that many questions. So here's the part. Here's something that it's just a thought in my mind that, look, I'm not pretending that I'm some large account here, like I have some following going. I'm a small fish in a very big ocean, but I do have a small platform. And one of the things that I wanted to, I made a post on Twitter. Let's get to that first. Let me just show you what I said on Twitter that sort of started this off and why I might actually rant a little bit, not negatively, not calling anybody out, but just talk about more than what Twitter allows us with, 280 characters or whatever it is these days. It's just totally inadequate. So here's what I said. The world's becoming a weird place, and it seems people are less and less accepting of middle ground views. I'm pro-vaccine and vaccinated, which I am, and I'm also very against infringing on people's right to choose for themselves what they feel best for them. Why is this controversial? Apparently it was pretty controversial. Now, not for everybody. There was a lot of people that agree that while we might disagree as human beings, it's not that controversial to understand that other people think differently than we do. But there were some people that, were fairly fairly direct, talking about how it's a obvious public health issue and it's crazy not to force people to do certain things. So what I wanted to do, I'm not going to rant on the pros and cons of any of this. You obviously make your own decision. But what I wanted to talk about is I don't know if you've all noticed, I'm certainly not the first person to point this out, but the world is becoming more polarized in how we treat each other. And we are sort of moving to the extremes more and more these days. Obviously, it's because of social media. You don't get your voice heard unless it's a little bit more shock than what you would normally have said, right? Nobody says, hey, I believe in both issues. I can see, pros and cons on both sides. It doesn't really get a lot of eyeballs. What you really want to do, if you want to get people interested in what you're saying, is say something that's a little bit shocking, right? A little bit extreme. Call people names a little bit. If somebody disagrees with you, it's not a disagreement between adults. It's a disagreement between smart person and stupid person. That's going to get more views than saying, I disagree with you, but let's talk about your perspective. I want to hear why we disagree. That's interesting to me. Oh, you think the opposite. I wonder why. Let's have a conversation. That's not what we're doing as a society anymore. What we're really doing is saying, in this example, but I don't want to make it about the, the vaccines and stuff, because I am pro-vaccine and pro-science, and I got mine as soon as it was available. It's not really about that. What this is more about is just me trying to encourage a few of you, and maybe if it only resonates with one or two people, that's fine, to be a little bit more understanding of point of views that you don't share. Because while you might be completely on the side that this is a clear and present public health issue and it's absurd that we don't just force everybody to comply, you might be on that side, and you have every right to think what you want. I'm fine with that. You have to understand that there are some people in this world that feel it's not a public health issue. They feel like it's more of an infringement issue. And you might disagree, but I promise you, you know exactly how they feel in a different context. Sometimes we get very emotional when it's something we deeply care about. And let's be honest, what we went through in the last couple years with this experience globally, we all went through a myriad of emotions that we did not see coming, and hardships and difficult times. There was nobody exempt from it. Some people suffered way worse than others. I feel blessed that it didn't overly affect me that much, but there was nobody unaffected by it. It was hard. But even though you disagree with those people that are choosing to be holdouts and not doing what you want them to do, and forcing them to do the things that we want them to do, I guarantee you in a different context, you understand perfectly well what they're feeling. So what I wanted to do is just sort of have a rational discussion about what some of those things would be, and maybe give you some context about why they're thinking the way that they are thinking, and why somebody like me, who does disagree with their overall decision, just being perfectly frank, I do wish that everybody would go out and do what we want them to do and the world could get back to normal. But why someone like me might say, I disagree, but I am still going to show solidarity to the people out there who I disagree with, because there are causes that I have that are important to me that I would like other people to show solidarity with me. And if on a cost-benefit analysis, it's not completely diabolical on either side of the equation, then I would like to just show support for people, even though I do disagree with them. So one of the ways, have you ever, and I know you have, I know I'm not speaking out of turn here, I know everybody has, but that feeling where you just wake up and you look at the world around us and you ask, how did we get here? How did we allow this to happen? Not the recent stuff, anything. I've got a few examples here. Hopefully they're not too controversial. Hopefully it will include a larger audience here. But take the idea of cancel culture. You can't just go out and cancel somebody because you disagree with them. That's obscene, right? Obviously, everybody in the world agrees that you should have a right to speak. Freedom of speech. We all agree with that. But how do you get to a world where it is actually okay to just shut somebody's speech down and nobody really puts up a fuss? Well, it doesn't happen overnight, and it doesn't happen in one step. What it is, and what I'm trying to get at today, is this is a psychological pattern that is present in our world in every aspect of society. This is how things get done. It is small, incremental psychological conditioning to go from one place to another place that if you went too quickly, it would seem absurd and obscene, and plenty of people would put up fights along the whole way. But if you do it slow enough, in small increments, nobody notices. So if you want to get to a world where you can actually stop someone from speaking because you disagree with them, you don't just stop them from speaking. You'll have tons of conflict. What you do is you find somebody who said something so egregious, so terrible and hateful, that nearly everybody agrees we need to shut that person up. That person is not beneficial in our society, and we need to shut them down. That's step one. Everybody agrees, no pushback. Wait a few weeks, ban somebody else who's adjacent to what they said. Sounds kind of similar, but they didn't actually say directly what that first awful human being said. Ban them too. Then you get to a point where people are starting to get comfortable with this. Okay, now ban somebody who, under the right context, it's pretty obvious they didn't mean what you thought or said that they meant, but they kind of used language that was adjacent to it, so let's ban them too. On further inspection, you know that's not what they meant, but doesn't matter, it's adjacent, we're going to ban them too. Now you're going to start to get a few more people pushing back on this idea, but most people are going to agree that we still need to shut down that speech. Go another step further. Now you're just banning people who are quite clearly not saying what we say that they're saying, but it just sounds similar. It just feels like maybe in a certain context, yeah, we'll shut them down. And then eventually you get to a point where you're just banning people because they're a member of the same group. And that person that was banned looks around and says, I didn't say anything wrong. I didn't do anything wrong. I don't even know those people. And then society looks at it and says, well, you're a member of the same group of those other people, and you're going to lump you in. Whatever 6 degrees of separation, you are part of that group, and now you're banned. And you wake up one day and you realize that we accepted A, B, C, D, and E along the way, and now we're allowed to just ban people we don't agree with. That would have never flown in the past, right? Another example would be, like, I'm trying to include other people so you realize that while you might not disagree with the actual, I got to be careful with the YouTube algorithm, but getting the thing that we want everybody to get, there are causes that you stand for that is the exact same psychological pattern. And one of those would be our cyber data, right? Are you in favor? Did you wake up in 2021 and look around and say, this is fairly unacceptable? We've got these social media companies literally selling our data to target us and allow third-party marketers to make money off us as well. How did we get here? Well, it didn't happen at the launch of the computer. The government didn't come in the 1980 and say, we're going to do this. What they do is they start with something very small. They say, put your name and address in this book. It's no big deal. It's just a book. It's just a ledger. It just put your phone number in there. It just allows us to contact each other. It's a net positive for society. Okay, I'll put my name, address, and phone number there. Then you come back later on and you say, okay, well, now we need a little bit more information. We need, who you're married to, whether you're divorced or not, whether you have kids or not, what your family's like. That seems like a little bit of an ask. Maybe I want to get off this train, but people go along with it. And then you get to a point down the road where they're like, okay, now we need to track where you're actually going. We need to track what you're doing, what you're buying and selling, what you're searching in search engines. Now there's more and more people saying, hold on, this isn't about what it was originally. Now this is about infringement. This is about the slippery slope of agreeing to A, B, C, D, and E, and then you get to F and you're like, this isn't the world that I signed up for. That's what happens with cybersecurity. What about something else? Let me give you a quick example. Let's draw this back to investing. Is this acceptable to you? Federal balance sheet, Federal Reserve balance sheet, 8.3 trillion, well, that's the debt, $8.25 trillion Fed balance sheet, a federal public debt of $28 trillion. Is this acceptable to anybody? Did you wake up in the world in 2021 and look at it and say, how did we get here? How did rational people allow this to happen? Well, it happened because it started at zero. And the government didn't say, I've got this brilliant idea, we're going to borrow $28 trillion and we're going to get this economy going. What they did was, I've got this small idea and we just need to borrow a little bit. just a little bit. And everybody says, that's great. Let's get this economy going. Everybody agrees. Then you get to a point where they say, well, you got to save the auto industry. There's tens of thousands of jobs on the line, hundreds of thousands. We have to spend money and save the auto industry. Everybody agrees. Well, infrastructure's crumbling. Sure, it'd be great if it was based on GDP and revenue, but no, we don't have the money, so we're going to borrow it from taxpayers, and we're going to fix these roads. Roads need fixing. Telecommunications needs upgrading. We do these things. Great, we agree to that. Now we need a tax cut for the wealthy. Why? I don't know. It only helped 10% of the population, but apparently we need that. So don't worry, it's going to trickle down to the rest of us. They're going to eat most of the pizza, but they're going to give us the crust. That's the story. So we agree to that. Now all of a sudden, the Fed balance sheet is $8.3 trillion, and a lot of rational people who didn't see any problem with saving the auto industry are now turning around saying, hold on, guys, the debt is $28 trillion. I didn't sign up for this. I accepted A, B, C, and D, but I'm on this train just like you are, but it's time for me to get off this train. I can't just keep going to the next stop and the next stop and the next stop. I have to actually get off this train. What I'm trying to get at, and ranting, and, you know, I'm sure most people agree with what I'm saying, but the actual issue, I saw it a real funny way of somebody else in another video said it's called, to get around the YouTube algorithm, it's called going to Bill Gates' house. So the people who are holding out and refusing to go to Bill Gates' house, it's not about that. It's not about a public health issue. Here we are pointing at them and saying they're discompassionate people. They're selfish. They don't care about the public good. This is a public health issue. And some of them, of course, there's always crazies in every group of people. You know, there's always a small percentage of people that really are anti-science and really don't know what they're talking about and really do have a tinfoil hat on. A majority of those people are not looking at it as a public health issue. They're looking at it as an infringement issue. They're looking at it in the same way that we got a Fed balance sheet that is so obscene that nearly everybody disagrees with it now. Well, the time to fight against it was earlier on, right? It's the same exact way that some of you watching, I don't know how many people are watching right now, but some of you watching, at some point, you've purchased some stupid options trading course online. Some of you have. You paid $5,000 for some dumb options course that you never got through chapter 2, right? Totally useless. Or you bought some trinket or something online that as soon as you got into your house, you're like, well, why did I even buy that stupid thing? I don't even want that. It's the exact same reason as the vaccine situation. It's the same thing as the Fed balance sheet. This is marketing 101. It is slow, incremental, psychological changes that nobody notices along the way until you've swiped your credit card. You start on day one, you don't say, give me $5,000. Everybody's going to delete that email. I delete them every single day. But if you send somebody an email saying, sign up for a newsletter, relax, it's just an email. Who cares? Just give me a burner email. It doesn't matter. Put your email on this list. Okay, wait a couple weeks. Send them an article. I wrote this article. I think you might be interested in it. Check this article out. Okay, wait a few weeks. Then send them something privately. I need you to click this link. It's totally free. Don't worry, you're not paying anything, but it's a private link just for you. It's specialized just for you. Get them comfortable with clicking that link. Then hit them with okay, now you can sign up for a trial. It's only $10 for the first month. You can cancel at any time, don't worry, but it's $10 this month. No problem. I'll sign up for that. It's so cheap. 15 steps down the road, then you hit them with, I've got a course for $5,000. It'll help you become a millionaire. I'll help you become a crypto millionaire. Here's my course. And some people buy it. That's how it happens. So it's the exact same reason that I tweeted out what I tweeted out. This is not a pro or con against the subject matter of, I've already said it on YouTube, I think, so it's not like I'm beating the algorithm anymore, but it's not about that. It's about psychological conditioning over time. And some people in our society, not everyone, not me, obviously. I went out and got mine as soon as it was available. As soon as my name was on the list, I went out and got it. I did my research. I checked it out. I made the decision for me and my health, and I went and did it. And I do hope that other people make the same decision. It's about certain people giving them the right to get off that train when they want to get off the train. That person rode the train with me. They wore the mask. They locked themselves in their house. They shut down their business. Imagine that. Imagine how insulting it is for someone like me who took the vaccine as soon as it was available to me to turn and point my finger at somebody else and call them selfish and call them, you don't care about the public health. This is a person that inconvenienced their life for a year and a half. They invested money in a business. They took the risk of building it. Blood, sweat, and tears went into that. 85% of businesses fail even in the best of times. And during last year, we scuttled thousands of people's livelihood. They held their kids out of school. It's not like U.S. health or education system was rocking the rest of the world anyway. And now you've got 1 year of your kids behind. They rode that train with me every step of the way. And now when they're ready to get off because they want to go to a Broadway musical without going to Bill Gates' house, now all of a sudden I'm going to call them selfish and ignorant of science? And that's insane. I mean, no, it's just a person who disagrees with me. It's a person who rode the train to Station G, but they just don't want to go to Station H anymore. They don't want to keep going and keep giving. And we have to, like I said in the beginning, we have to show solidarity for people's causes, because at some point we're going to want people to show solidarity for our causes. We all have things that matter to us. And this issue obviously doesn't matter to me because I went out and did what I did for my health. But there are things that matter to me, and I want other people to be there to defend me as well. I know I'm not sharing anything something that you probably haven't seen a million times before, but there is a famous quote here. Let me just read this. I can't read all of it, and I know most of you have already seen this before. There's one word in here that will make the YouTube algorithm go ballistic, so I'm going to skip that part. But the basic quote, I'm sure you've heard, they came first for the communists, and I didn't speak up because I wasn't a communist. I'll skip the next line because it's a bad one for YouTube. Then they came for the trade unionists, and I didn't speak up because I wasn't a trade unionist. Then they came for the Catholics, and I didn't speak up because I was a Protestant. Then they came for me, and by that time there was no one left to speak up. That's the famous quote that is fairly apt in this situation. This is not about the thing. Maybe it is, maybe it isn't. That's up for all of us to decide. But a certain percentage of the population, it's about something else for them. Is it too much to ask that we at least have some understanding, that we at least meet them in the middle, that we can at least have a conversation with them without pointing and calling them idiots and saying they don't care about other human beings? They're in society too. Those people that are being called that for taking a stand on infringement, they have kids. Of course they care about the general public health. Of course they do. They just have a different opinion than I do. They looked at the research and they came to a different conclusion. I thought it was fairly incontrovertible. I went out and did what I did because, for me it made a lot of sense. I just don't want myself or one or two of you listening to this rant to be that person that says just because I believe a certain thing doesn't mean you do. Because remember, I'll say it a little more succinctly, but first they come for thee, and then they come for me. Don't ever forget that at some point, you're going to want those same people to stand up for you. And like I said, on a cost-benefit analysis, as long as it's not totally, diabolical differences on either side, maybe we can understand what's going on around us. Maybe we can have some recognition of historical context here. This is not the first or even the 1,000th time we've seen this sequence play out. This is psychology 101. This is how you get your neighbor to give you his car. Sounds insane. Why would my neighbor give me his car? Why would a person I barely know loan me his car? Well, because on day one, I didn't ask for his car. I went over to his house and I said, it's early morning. I'm writing a blog article. I'm out of milk. I want coffee. I want milk in I'm out of milk. Can you just give me a cup of milk? Awesome. I'll give you a cup of milk. You're my neighbor. Here's a cup of milk. Then you say, well, my lawnmower conked out. I need a lawnmower. Okay. I'll loan you my lawnmower for 20 minutes. That's fine. You can use my lawnmower. Later on, you say, hey, I'm late for work. My car broke down. Is there any way you can just drive me to work? Is this too intrusive? The guy's like, hey, we're neighbors. I'll drive you to work. Buy me a coffee and a donut. We'll call it even. Great. Several months down the road, 17 steps later, you say, I don't want to inconvenience you. I do have a driver's license. I'm insured. You're insured. I'm a safe driver. Why don't you just give me your car? You can stay home. I'll go to work. I'll give you the car back. I'll top off the gas for you. Great. Your neighbor hands you the keys to his car. How did that happen? How did you convince somebody next door to give you his car? The same reason you convince people to do all these other things in society that we convince them to do. Slow, small, incremental steps. Okay, that's the only point. I mean, how many more examples do you... It's all around us. It's all around us. And I just don't understand why people don't recognize that differences between us are what makes society. We shouldn't be dividing because of the differences. We should be living together and embracing the differences. Now, that doesn't mean that we should just go do every wacky, crazy idea that somebody has. Obviously, we have to weigh it and, decide what's the greater good. But you'd be surprised. Well, maybe you wouldn't be surprised. If you have historical context, you definitely wouldn't be surprised. But what people can agree to if you warm them up to the idea slowly. The frog boiling in the water. I don't actually think they do that. I think frogs do jump out of the boiling pot, but the analogy is basically if you put a frog in a boiling or a cold water and you just slowly turn it on, then it boils and they die. I'm going to go ahead and show solidarity to all those people that feel like they've seen this movie before. They've rode in the train with me all this way. They've sacrificed so much. They've been through so much. And now they're at a point where they kind of want to get off the train. And I'm not getting off the train, but I can totally understand why other people would. So let's be a little nicer. I don't know. I don't want to be preachy. I don't want to be that guy, but let's try to be a little bit more understanding and just accept that different people think different things. And it's not always as diabolical and negative and selfish as we think it is. Sometimes, in the right context, we've all looked at the world and said, how did we let this happen? We've all had that experience. So I know I have. So that's my rant. That's what my tweet actually meant. It's hard to communicate in 280 characters, but I think more conversation, less vitriol would be pretty good in this day and age. I mean, social media 2021, it's making us do things we wouldn't normally do. We barely recognize ourselves online sometimes. And that's my little rant to my very small community of volatility traders who I'm sure you're all wonderful people. And if you disagree with me on a certain thing or a certain topic, or it certainly doesn't mean we can't be friends and we can't be in a community together and we can't, if we ever meet up and go golfing, that'd be awesome. I can certainly hang out with you if you disagree with me. It's totally fine. There's many ways to trade, many ways to make money, and you don't always have to agree with my method, but that's it. So let's get to some of these questions. I feel like that rant was probably necessary, but probably most people agree with me, I would imagine. But let's go to some volatility stuff. So what do you think of synthetics risk reversals to fine-tune delta, vega, theta exposure for stock replacement besides just long call? So essentially what they're asking, in the tactical volatility strategy, we buy long-dated VXX put options to exercise our short vol positions. What about synthetics risk reversals, where, depending on how you do it, you could sell the put, you can buy the call, and you can create something that tracks the delta pretty well. Basically, one of the reasons that I do that is it's more complicated a trade. It requires different trade permissions. We have a community of traders from all over the world. We've got 67 countries represented now. Everybody's in a different account structure. Some people are in margin accounts. Some people are in cash accounts. So we do have to do things that are accessible to the largest number of people possible. And stock replacement through long VXX puts is a really great way to get short vol exposure. It's got some pretty unique risk management characteristics built into it. And so I think everything has pros and cons, and a risk reversal, like you said, you can fine tune the delta a little bit better. You can track the VXX a little bit closer. But then there's also downside risk that you can lose more money. It's not capped losses, things like that. There's shorts to sell. Some brokers won't allow that. So that's basically the reason. If you know what you're doing, and if you're really good at this stuff, sure, you can do that. Anytime that I take a short vol position, you could buy the SVXY. You could buy the long VXX put option. You could, not recommended, but you could short the VXX. I don't recommend that at all, by the way, but you could do that. You could do a risk reversal. You could do synthetic trades. It's up to your knowledge and your account structure. But the reason that I do it on my end with the easiest, most accessible long put option, everybody can trade a long put option. That's why I do it personally. Okay, this is interesting. I have VXX at 10 mid-March. So do you mean next year, right? Remember, we said 2023. You're saying basically within, 7-8 months. Interesting. It very well could. Like I said, when you've got something like volatility ETPs, it's not consistent. It's not consistent at all. I mean, the performance over time, you can get in these waves where it really does go down significantly. Another thing that I pointed out in my recent video, if we go to the contango streak, maybe I'll update this next week because we'll have more time, but you can see we're now at number 5 all-time contango streaks. You can see that the average daily VXX decay per day is actually 0.5% during this recent 130-day run of very consistent M1, M2 VIX futures contango. 0.5 compared to, what have we got before? 0.238? How good's my memory here? What is it? 0.238. Yeah, very, very different. If we go to this one and we say that the VXX is 26 and this is minus 0.5%, if this sort of streak that we're in, remember I got to wait for my beach ball to go away here. If this current streak that we're in kind of lasts a long time, let's see how fast we could decay then. We could actually go, come on, MacBook, trying to make a point here. This person doesn't want to watch you struggle with this number. Remember, we said roughly 10, so 190 trading days. Now, 20 per month, you're talking about 9.5 months. You're pretty much bang on with your estimate if the VXX decays the same factor that it has in the last, say, 8 months. If it decays that, then you're going to be right. At some time mid-next year, the VXX is going to have to do another reverse split. UVXY might be even faster. So, but I'm using long-term averages because we're traders, and over time, you have to always factor in that volatility ETPs will spike as well. I mean, there's just no getting around it. There's going to be periods where it goes strongly the other way. We have to factor in a few of those along the way, and that's why it pushes us out to, just as a recap, to way out into 2023. So VXX, roughly March 24th, UVXY, roughly September 19th. That doesn't look right. Why did I do that? Sorry. That's definitely a mistake. Yeah, UVXY will get there a little bit faster. So good guess, very good guess. It's astute of you to notice that the VXX is decaying faster these days. But yeah, good call. Somewhere between 9 months and 3 years. It's going to be somewhere in there. Okay. On VTS, instead of buying, selling VXX, which decays splits, etc., why don't we buy the actual VIX options? Okay, good question. VIX options have nothing to do with volatility ETPs. It's a totally different structure, a different underlying asset. It's a totally different market. So the VIX options, while they settle to VIX futures, they are actually totally different in their movement, where the VXX is tracking the front 2 months of the VIX futures, and we can actually predict that decay factor. You have to remember that VIX options themselves don't behave that same way. There is no built-in decay factor that is matching up closely to the volatility ETPs. You can't just say, for example, short the VXX or short VIX options. That's not the same trade at all, and they won't behave anywhere close to each other. Those VIX options can sort of flatline and settle in, whereas the VXX could constantly decay, and the VIX options trader could be losing tons of money. On the flip side, that VXX could start bleeding upwards again, but the VIX options might be staying consistent. So totally different. I'm not saying you couldn't do that, but it wouldn't be the same system or the trade signal or the same timing. You'd have to specifically design a pure VIX options method and keep that separate from your VXX trading method. I think both could be successful. They are not interchangeable, basically, put it that way. How about holding VXX short and hedging with UVXY long above the 50-day moving average? Okay, you've layered quite a bit there. So first of all, 50-day moving average means nothing for volatility ETPs. They are not based on any supply and demand, no price dynamics at all. So a 50-day moving average means nothing. It could decay so far below that or could spike so far above that, it doesn't matter. So price itself is irrelevant. Therefore, technical analysis, certainly traditional price-based technical analysis, is totally irrelevant as well. You can't chart the VIX or the VXX. You can't draw lines. You can't use moving averages or support and resistance. None of that applies. So let's ignore that last part. Why can't you short VXX and then hedge it with UVXY? You could. Right? Your question, why couldn't you? You could totally do that. They are the same thing. I mean, VXX and UVXY have a different decay or a different leverage factor, 1 to 1.5, but the underlying methodology is identical. So when you're hedging your short VXX with VXX, UVXY is the same thing as VXX, you're essentially buying the SPY and then shorting the SPY. Why would you do that? Why wouldn't you just reduce your exposure? Why would you sell short the VXX and then buy the hedges when you could just reduce your VXX short exposure and not need the hedges? You don't ever want to do something that's redundant just for the sake of trying to get more leverage. Like, you're trying to short the VXX directly because you think that's the most profitable way to do it. Just go straight to the source. Just get that full decay factor. And then you're going to add layers of risk management on top of that to make sure you don't blow up your account. That's wise, but why wouldn't you just construct a better system from the beginning so that you wouldn't need to add all those layers of wasted money? And hedging is expensive, and it's redundant, and it costs long-term capital. Why wouldn't you just start with a baseline level of safety first and then build up from there? Why would you start with mass risk and then build lower from there? It's just... For me and my investing philosophy, you always start with safety. You always start with the lowest potential drawdown possible. That's your baseline. Then you look for ways to boost your rate of return on top of that. It's much more efficient to go about it that way rather than, okay, I could make a lot of money, but it's so risky I can't do it, so now I have to spend a bunch of money and make it safe. That's just not efficient. It'll cost you more money in the long run than it's worth. So... this is interesting. Is it good to buy and hold UVXY 5% as insurance? Well, 5% is a huge allocation of insurance with respect to UVXY. But sort of tying it into what I just said, why do you need the insurance? Why does your portfolio need hedging at all? I'm not saying it doesn't or shouldn't. I'm just asking the question, why does your portfolio need constant hedging? Is it too risky on its own? Is that what you're saying? Is that you couldn't possibly let it be? It would just be too risky, right? Why isn't your question, how do I reduce the initial risk of my overall portfolio so that I don't need the UVXY hedges? That's what I do. So, basic history of VTS, sometimes people look at, what I do, and sometimes they'll try to do some type of gotcha moment that the rate of return itself might not be as impressive as you're expecting, right? Long-term annualized at 19.5. Actually, the last 3 years, it's been 15, 10, 11, somewhere in that range. So it's even lower. It's probably, I don't know, like 6 or 7 less than that. But they look at this and say, well, this isn't what I want more return. Well, what they're not recognizing is that all of my work is based on consistency and reducing drawdowns. I have traded live. This is all live trade signals that went out to real paying people for basically 10 years now. We're coming up on 10-year anniversary with a 7.7% drawdown. That's it. The broad market suffered 35 there, 22 there, 18 there. I mean, or back in 2011, another 19 there. Only 7. So I always start with baseline safety that does not need additional hedging. All of my 5 strategies, every one of them has its own answer to what we're going to do when the markets get risky. So, for example, tactical balanced is going to rotate out of equities and into either bonds or gold when we need to. It does not need to be hedged by itself. The drawdown is contained. Defensive rotation is our tactical strategy as well. It does not need to be hedged. It will rotate out of stocks and into utilities or bonds or even cash. Then, now I have something that's really safe that has gone 10 years, and that was only one drawdown right there. The rest of them, we haven't breached about 5%. In the last 3 years, I haven't had a portfolio drawdown larger than 5%. So now what can I do? Well, now I don't need to hedge. Now I can actually add some leverage. Well, now we're getting somewhere. Now we're getting to a rate of return that is more in line with what people are sort of eyeballing and targeting out there in the general population. Still, the drawdowns are contained, but my point is I started with safety first. And then I'm looking for very easy, accessible ways to add return on top of that. If you want to be just totally safe and go for this one, that's fine. There's nothing wrong with this. But if you are a person who can take on a little bit of risk, I'm not saying you should suffer through a 35% drawdown like the S&P did just a year ago. But if you can suffer down like 11, 15, something in that range, then maybe you can target this portfolio. If you can even do more than that, well, I don't ever directly recommend it, but there are other ways to add even more leverage. Maybe you can suffer a 20% drawdown. Well, if that's the case, you could take my baseline work and double it. And then there's no argument for the rate of return anymore because it's 5 times better than the benchmark. Always start with safety, then build. So let's get back to your question of why I'm going off on this tangent about the 5% insurance. My question to you was, sure, you can do that. You can buy a decaying product that's going to cost you money long term, constant bleed, or you can shift your investing philosophy towards safety first, then add layers of return on top of that. I'm not saying you have to, my live streams are free. Don't ever send me any money. Don't super chat me or anything like that. I don't want the money. You could give it a like if you want, but don't send the money. But you could adopt something similar to what I do within my community that is assume everybody out there has an incredibly low risk tolerance. Make that assumption. First, they're investing their entire net worth. I can't go off on some crazy tangent and try to make 50% a year. These people are investing their entire net worth with me. That's the first thing. Secondly, assume they have an incredibly low risk tolerance. Build a portfolio that this person with their whole net worth and their entire future livelihood is invested in my strategies and they have low risk tolerance. Give them something that will allow them to sleep at night. That's level 1. Then build on that. Then say, okay, you people separate yourselves with larger risk tolerance. You can add a little bit of leverage. You can trade the QLD and not the Qs. You can add the MVV, not just the MDY. There's more things we can do with that. You can trade the aggressive vol and not just the tactical vol. It's my investing philosophy. I'm not saying you have to adopt it, but it's worked out pretty well for me. Start with baseline safety and add from there. Don't start with risk and then add hedging from there. It's kind of the same question as this one. You're going about it backwards there. Reassess your philosophy and you won't need those UVXY hedges that will bleed capital just consistently over time. Plus the problem of calibrating that hedge so it's just efficient enough that it doesn't drag down your portfolio and it hedges you in just the right time. I'm telling you, that's high level math to figure that out, to get that calibration correct of enough hedging, but not too much hedging. Far easier said than done. I mean, you have to get into very detailed beta calculations of how much your portfolio moves in certain environments and what your correlations are and how that's going to relate to a UVXY long position. And very, very difficult work to get all that done. So I'm not saying pay me money. Don't do that. You know, of course, people can subscribe, but check out my work. Understand why I do it the way that I do and why I've been successful for so long. It's not, you know, maybe I think I'm pretty smart, but it's not because I'm some brilliant guy. My focus is hyper specific on risk management first and then building from there. And it works out really, really well. Yeah, there's always ways to add risk. What you don't want is what we often called, you know, people confusing alpha with just shit beta. Basically, you're just leveraging something that's garbage and you're trying to get a better rate of return based on leveraging garbage. If you take double S&P 500, you're going to suffer massive, insane drawdowns. During good times, you'll get the leverage and it's high fives all around. During bad times, all you've done is leverage something that draws down 35%. Is that a good idea? No, it is not a good idea. Nobody can watch their net worth draw down 35%. That's just not how the reality of the investing world works. So start with safety, build risk on top of safety. This seems off topic. Oh, okay, this is interesting. Okay, I wish you would only talk about the markets and not the vaccine, UFC, or ice cream, as we're here for. Fair point. Good point. I am going to be doing, so I've done roughly 1,000 articles and videos, totally free to the public. There's, you know, hundreds and hundreds of articles on my website. There's going to be, in the future, thousands of live streams and videos directly targeted for people who really do want just the good stuff as you're trying to get to. So, I mean, if you scroll through my work that I've provided for you for, you know, free of charge, of course, don't send me money, don't do any of that. Are you saying that I can't add a little bit of humanity to what I do? I mean, I don't know. It's a fair point. I acknowledge, you know, thanks for the feedback, but today was abnormal. I mean, typically 99% of my stream is talking about investing. It was just today. I had something, you know, I wanted to just chew on a little bit publicly and see what happens there. But I assure you that the vast majority of my work is not that. If people want, I'm a real human being. I'm not just some avatar online. I'm a person, and we have a community, and I have a lot of people who follow me. They sometimes do like to know about me and my interests and what I do and who I am. And I try to give a little bit for everybody. So I do apologize if you've felt like you had to suffer through something that you didn't sign up for. I assure you we'll get to the volatility stuff the vast majority of the time. Data running test for yourself. So you can, this is interesting. Same person, different question at a different person. So, but I do appreciate the feedback. I'll make you a promise. For the next at least 3 live streams, I will try to keep the off-topic stuff to a bare minimum. How about that? Sounds like you have a lot of interesting ideas, but not willing to test them. I suggest getting the data and running tests yourself so you can precisely quantify them. I don't know the crosstalk that this comment was made, but I know what you're saying, and I agree with this 100%, that oftentimes, and this is what my live streams are for, I'm here to answer your questions and just to provide my context. You know, I've got a lot of gray hair, got a lot of life experiences, some success, some failure. Hopefully people learn a little bit from my experience. But asking questions is awesome. But what's even better, and what this person is getting at, is getting the correct data and testing it yourself. Because what you will find, you'll ask a question. I wonder what would happen if a trader shorted the volatility ETPs only during VIX futures contango. I wonder what would happen. You can ask me. I got that number. If you want to see it, I've got that number. 23% annualized, I think is the number. I can tell you that. But what would be better is you get the data for the VIX futures going back to 2004 and run the numbers yourself. You'll get the same answer as me, but what you will find is in the process of doing that, your brain will ask you 4 other questions as well. So in the quest to get the right answer, you'll have a little to-do list on the side. Well, now I have to do 5 more things. Now I have to do 20 more things. Now I have to ask myself, well, okay, what happens if I only short it if it's 5.6% at contango? And now I'm going to go long volatility when it's more than 7% backwardation. And all of a sudden your brain starts to go in a direction that leads you to a point where you're like me, your spreadsheets don't even work. They're so long. You know, you've got so much data and so many ideas, and this is spreadsheet 2. I've got 5 that look just like this. That's what ends up happening. So very good comment here from AB. Nothing wrong with asking me. I'll be here and I'll answer your questions as openly as I can. But feel free to test some of these things yourself. You might surprise yourself how far down the rabbit hole you go with these things. Could get you to an interesting place. Yeah, very good comment there. Love my rambling on tangent. See, there you go, buddy. AB, where are you? You don't want me to talk about anything to do with it, and this allows me a little bit of leeway to give my human opinion on things. You don't have to agree with me. You might have, I think I ranted for 20 minutes. You might have just disagreed with everything I have to say. But you know what? If we're ever in the same city, we can still meet up at the coffee shop and we'll still be polite to each other and we'll still agree to disagree. That is just fine. So, tolerance is hard to find these days. It is. Let's, the world used to be 90, and I should say the world still is 90%. Everybody's in the middle. On a Bell distribution, we have so much more in common with each other than we have gripes and disagreements with each other. Even the people that are on the other side of the equation, you're like, I disagree completely. You'd probably find that you agree 100% with 9 out of 10 other things that person has to say. So, I mean, we can all pick and choose and we can all push ourselves to the edges if we want, but, you know, that's not beneficial for any of us. I think a lot of us agree on most of the major things in this world. We're all intelligent, compassionate adults. We're just doing the best we can. Here's another AB. I keep clicking your name here. With Tactical Vol, how should a subscriber choose when to buy SVXY versus buying a VXX put? I'll finish it and then answer that one. If buying a VXX put is better, why not sell it out of the money option to reduce the cost of the premium? Okay, so the first part, you can do either. They are essentially interchangeable positions with different pros and cons for both of them. So the pros to using, say, an SVXY, for example, is that there really is no decay factor. The SVXY itself has decay, but the position does not have that negative theta that a long VXX put option does have. So SVXY, if it stays flat for a while, you will also stay flat for a while. Whereas the person who buys the put, there is a tiny bit of decay there. Now that's why I do long dated contracts. I always do at least 100 days, ideally 120, 130. Try to keep that delta or the theta factor really low. And then we'll rebalance if it gets within 80 days or so. But that's one benefit to SVXY versus the other one. On the flip side, when you buy an option, you're not allocating all your capital. You're only allocating maybe 30 or 40% of it because options are cheaper than the underlying ETF. So if we get some wild, crazy spike that just wipes out the ETF, obviously we hope that we're picked up the signals early and we're not in the trade for that. But the VXX put owner maximum could lose 40% of their capital. And since that 40% is only 20% of the overall portfolio, they can really only lose about 8% of their money, even if the world blows up, for that volatility position. Whereas the SVXY person is on the hook for a little bit more of that. The short VXX direct person is on for way over 100% of that. The short naked UVXY call trader is on the hook for 1,500% of it. So it's a spectrum of put option buying is the safest, but it comes with a little bit of decay, all the way up to the naked UVXY call seller, which nobody will ever show a track record of success in that side of things. pick in between. You can sort of find your risk tolerance in between those. And that's what I would say. They're interchangeable, but they are slightly different in the pros and cons. Premium seller. Good. In general, we like to be sellers of premium. I like your name. I found your YouTube channel yesterday and love the content. I am an options seller and always carry short Vega, positive Theta and negative Delta. Wondering if we can use your service in a way to know when vol will expand so I can exit my short vol positions. This seems a little bit self-serving for me to answer the question in this way, so apologies for that, but it's sort of a direct question. Let's go to my daily emails. What did I send out? The last one here. This is VTS paid, not that one. This one maybe. Let's go to the most recent email. What I could probably help you out with is gauging volatility levels itself. You're going to be on your own for deciding how you're going to actually exercise the volatility metrics in the method that makes sense for you as a premium seller. But as far as the actual timing goes, this is what my work is based on. It's based on timing volatility and making sure that we are hitting the short vol trade really hard when it's the most beneficial, and we're getting out of it when it's the least beneficial. Obviously, in trading, there are no guarantees, and even if the metrics are completely diabolical, that doesn't mean that you couldn't make money doing something, right? All I'm trying to do is do the right thing as often as possible, do the wrong thing as least as possible, and in the long run, the law of large numbers takes over and I make a bunch of money. I make a lot of profit. That's what my work is based on. So you could, if you wanted, again, this is not a marketing campaign, but if you wanted to follow for just the volatility gauges, and then, for example, after this blog that seems to be really long, if you want it, like when I say buy the long VXX put option, this is the position we're in right now. You could then look at that and say, well, he's saying that the volatility is in a pretty ideal range to be short vol right now, which it is, right? I'm sure all of you in the comments are short vol right now. Then you can turn around and now you can exercise your positions based on what you think makes the most sense for you. That's what I would say, is that there are ways to deviate from my literal buy this December VXX put option at 45 strike. You can deviate from that and you can say, well, I actually prefer to roll shorter dated contracts, and all I really want to know is, can this guy just tell me when the green light, yellow light, and red light for actual short vol is? Maybe that would be something you could look into. Again, apologies for that. Sounded a little bit self-serving, but I don't ever do any hard sell marketing of any kind. I'm sure you've noticed. I don't do any ads, or I don't do blast emails or marketing campaigns. The marketing funnel that I was telling you, that this is how you get somebody to buy a $5,000 course, I don't do any of that. You can sign up for my email, my newsletter, but I won't be sending you, I won't put you down a funnel. I've never done that, and I never will. But, yeah. Love your content. Thank you. I've watched your videos about how it's not a good idea to quit one's job and invest for a living. That is absolutely true. I was wondering if you'd be willing to share your net work was when you started investing full time. I assume you mean net worth. Do I want to share that? I can be vague about it. The reason that you should never quit your job and be a full-time trader is because I'm sure you've heard it said before by maybe Albert Einstein, maybe not. We're not exactly sure if he actually said this or not, but the eighth wonder of the world is compound interest. I'm sure you've heard it said in some variation that the power of compounding is just incredible. You know what's also incredible is the negative power of negative compounding. That's also really powerful. So if you're withdrawing money from your trading account to pay your rent and to put food on the table, you are amplifying and compounding the incredible eighth wonder of the world, compound interest, against yourself. So you should never withdraw money from your trading account. That's why I say it. I never discourage people from being very active traders. I always say, this should be a lifestyle for us. We're trying to get to the finish line as multimillionaire investors. That's what we're all trying to do. I would never say don't do that. I would never say don't spend every available time in your leisure to work on your investing skills. Please do that. Put the video games down, get out your Thinkorswim platform and start crunching numbers. I always say that. But don't withdraw money from your trading account. That probably means for most people, you need a base income. So what you're getting at, and I'm not going to give you exact numbers, but I'll give you something here. I retired from golf in 2005. I used to be a pro golfer. And I started full-time trading with basically no other source of income for 6 years. And I did that myself. I learned the lessons the hard way. I was very good at investing early on. I had a really great rate of return. These days, in the last 10 years, it's been roughly 25% a year. Back then, it was probably closer to 35 in those first few years. But if you just do the numbers, let's say 40, because I was a little bit riskier back then as well. If you just run the basic numbers, let's say when I retired from golf, I had $200,000, something like that. If you make 40% on 200 grand, what are you left with? Well, you've made $80,000 on your money. You pay taxes, you pay capital gains, you pay your bills, you pay your rent, you pay your food. What you end up with, even though that's a decent chunk of money, I mean, what percentage of Americans have hundreds of thousands of dollars in their trading account? Very low. And what percentage can make 40% a year? Almost none. But you're still left with a number that gets you negative very quickly. So I personally found that despite the fact that I was really, not to toot my own horn, but pretty good at investing, I still wasn't growing my money. So in 2012, I launched my service. Basically, I had a choice: put on a suit, go downtown, join a firm, or do it myself. And I chose to build my own brand and do it myself. But I do this for income because you just can't pull out money from your trading account and make any forward progress. Even if you're a millionaire, the numbers still don't add up very well, because if you just had a base income, you wouldn't have to pull out $5,000 a month from your trading account. And that money would compound to many millions in the future. So even if you are fully capitalized and can do it, it's still a dumb idea. That's why I say it. So for me, fill in the numbers on any number that you want, but I'm telling you that despite my really high rate of return, it still wasn't enough to overcome the negative compounding of pulling money out of a trading account. It's just, it doesn't add up for anybody out there. So again, trade as much as you possibly can, but get yourself a base income as well. For sure, get yourself a base income. And then go nuts with your trading. Like I said, stop playing, I don't play video games, but Call of Duty, stop playing Call of Duty. Start trading. Start focusing on things that actually help your life. The video game is growing your account. That's your video game from this day forward. It's not, doing raids on, I played a game when I was in college for a little while, Diablo. It's not building up a character, right? It doesn't matter what armor you have. The game is building your trading account. That's your video game. So focus on that. Just don't pull money out of your account. Please don't do that. Looks like the last 2 or 3 questions here. And I've been going a while. That rant was long. Apologies. Hopefully somebody found value in it. Most VIX spikes end within a week. Do they? Do you have data to back that? I'm not doubting you. When people throw out things like that, I always say, can you prove that in a spreadsheet? Because if it can't be modeled, then it can't be confidently stated, right? If we're just guessing, I don't know, I'm not calling you out, but do they? I would say most do. Sometimes they go insanely high. Let's move on. Let me not cut it off so quickly. Let's go on. Is it not possible to design a spike-only trade where the profits on the majority successful outweigh the losses on the minority that fail due to protracted spikes? I like this question. Answer is no, it is not possible. Because like I got at before, mathematically speaking, losses are far more punishing to your long-term performance than any multiple periods of gains. So if you designed a system where you're trying to say, look, volatility spikes, 80% of the time it declines within a week. I want to short that down and make money 80% of the time, and I'm going to risk that 1 in 5 where it actually keeps going. but you think that the 80% short vol will outweigh the 20% where it crushes you. I'm here to tell you that's not what's going to happen. Not only for the reason that volatility can go a lot higher than people realize, right? Let's not forget that the markets didn't begin on January 29th, 2009, when the VXX was launched. Markets existed long before that. 1987, Black Monday, the old VXO calculation for the VIX index that was based on the S&P 100 rather than the S&P 500, if we go back and reenact that, the VIX went to 172 intraday, and it closed at 150 on Black Monday. Went from 32 on the previous Friday to 150 on the Monday, and intraday 172. 10 years of VXX data is a blip on the radar of the stock market. So let's not discount the possibility that there is another flash crash of epic proportions. There is a cyber attack on the horizon where somebody does something terrible to the New York Stock Exchange. Let's put that on the table as a significant possibility. What's going to end up happening with this strategy is you're going to be right most of the time. That one time that you're wrong is going to completely devastate you. Getting back to what I originally said in the very beginning when I was talking about, things that matter, volatility trading, I pointed out the fact that very few people recognize. This is what volatility looks like on a log scale chart. This is what short volatility looks like in an actual practical trading sense. Short vol gets destroyed on a rolling constant basis. Why? Because these spikes are way more costly than 6 months of good progress. That's what happens. When you're going to be losing, if you have a 10% drawdown, it's going to take 11% subsequent rate of return to get back to break even. No big deal. If you draw down 25%, it's going to take a 33% subsequent rate of return to get back to break even. If you draw down 80%, like short vol will on you sometimes, now it takes a 400% subsequent rate of return to get back to break even. That's going to take months or years. One little blip. A COVID blip that's even more than that, if you have a 90% drawdown, it takes a 900% rate of return just to get back to the same point you were before. The VXX and the UVXY specifically went up 1,500%. We're not talking about some little, the losses are going to be, it's going to hurt, but all these gains are going to pay off. No chance. If you try to adopt this type of philosophy, this is literally why we say picking up pennies in front of a steamroller. This is literally what it is. I'm not picking on you. Great question. Nope. Losses can compound far, far faster than gains can be beneficial. You could put yourself in a position where one mistake in February 2018, Volpocalypse 2018, one mistake on one day, and it will take you to 2030 to recover from that mistake. You suffer an 80% drawdown in February 2018. You now need 400% return after that just to break even. You could post on Twitter that you made a 70% rate of return every year for nearly a decade, and technically speaking, you've barely recovered from where you started from. It'll look like you're the smartest trader in the world on Twitter. Look at this guy, just rinse, repeat, 70% rate of return every year like clockwork for the last 5 years. He's incredible. Well, he still hasn't broken even from that massive mistake he made 4 years ago, right? That's how this works. So I totally understand what you're saying and what you're asking, and it seems logical because you're right. I picked on you a little bit at the beginning, but you are right. Most volatility spikes get faded pretty quickly. That is absolutely a true statement. Definitely encourage you to calculate it in a spreadsheet and tell me the exact number, but that's true. You're absolutely right. Probably even more than 80%, probably 90% to be honest. But the other 5, it's going to hurt. The other 4 is really going to hurt. The other 1% is going to put you out of business for a decade. That's the short vol trade. That's why. That's why people don't understand why their account isn't growing. All those people on Twitter told them that you're just supposed to short vol. Well, how come your trading account is at the same value today as it was 3 years ago? How come? Well, practical real-world compounding geometrically works a whole lot different than the old picking up pennies in front of the steamroller concept. Oops, don't open Wirecast. That's a stupid website. So awesome question. Great question. Don't do that. Please don't do that. Start with safety, manage risk, look for ways to add slight amounts of rate of return, and be happy with your 15% a year. You're going to retire a multimillionaire if you can make 15% a year. You're going to be putting every hedge fund manager to shame. 95% of all the world's best investors, your 15% a year will put them all to shame. Focus on that. How did you get to that expiries for UVXY put? How did you balance theta decay and vega risk? Going further than 110 days out would reduce theta but introduce vega risk. We don't do UVXY puts, so I assume you mean VXX. How do you get to the expiries? I just choose basically, it's a discretionary call. I think what you're asking is the difference between saying I'm going to buy a put 60 days out versus 200 days out. Discretion. Which strike, the 40 or the 45? You're basically just trying to align the positives and negatives, right? The negative factor of a long VXX put is the decay, that you will suffer that theta. So you have to balance that. You have to push it out in time. But if you push it too far out in time, then that position isn't as responsive to moves in the VXX, and even in good times, you won't be making the profit that you're looking for. So you got to shorten it up. If you shorten it too much, it becomes susceptible to gamma risk. You're dancing on that gamma knife edge. So now you have to extend it further. If you go to the 30 strike, you won't be too far in the money and you won't be getting the delta exposure that you're looking for. If you go too high, well then you're going to be exposed to all the spikes. It's basically a game, and all trading is like this, of pros and cons and trying to find the best, most efficient frontier that you're going to be balancing on. It's not about, hey, this is nothing but all good and no bad. There's no such thing. There's always positives and negatives with all trade structure. There's a time and a place where an iron condor is slightly better than a straddle. There's a time and a place where long SVXY is a little bit better than the long VXX put. There's a time when the 40 strike is going to be more efficient than the 30 strike. On balance of probabilities, try to choose the efficient frontier that matches your risk tolerance. I know what mine is. I'm very good at this from my end. Other people can make substitutions and changes based on what works best on their end. I am here for the overarching philosophy, the hyper-specific trades that I send out every day, the very detailed analysis of when it's probabilistically okay to short vol and when it's not. That's my job. All of the followers of my work, your job is to tweak it if you want that matches up closer to your risk tolerance, because we're all different. I like I said before, I start with the assumption that you as a subscriber are trusting me with your entire net worth, and I simply cannot get risky with your capital. I'm not going to be responsible for you setting yourself back 10 years because you listen to this dummy talk about doing something stupid. And I also assume that your risk tolerance is really low, right? That's why I come to the trade decisions that I come to. And then I offer leverage solutions and live streams like this where I can help you add a little bit of risk and everybody gets the rate of return that sort of, you're not going to get what you want, but you're going to get closer to what matches you. So that's what I would say. Any thoughts on trying to get into the institutional investing space and managing client money for a cut? Not at this time, no. I keep pushing this video that I should just get around to just make the stupid thing. Why do I manage a subscription service, right? Why wouldn't I do what you said, institutional investing? Why wouldn't I start a fund? Why wouldn't I be an RIA? Why wouldn't I join somebody's hedge fund? You know, there's like 4 or 5 reasons why I personally do it, but let me see if I can rattle off a couple of them. Well, first of all, you're highly restricted for what you can trade. And I don't like that. I like to just get people what works best, period, end of story. Full stop. I only send out trade signals that are efficient at making money. I'm not trying to appease a compliance officer. I'm not trying to fit it in with somebody's tax structure. I'm not trying to say, well, okay, this is the best thing, but this sells better on a marketing side. This will sound better in a webinar, so I'm going to sell this strategy. I just do what's best, because VTS, all it is, 100%, is just me sharing my own portfolio. And I never make any decisions for my own money based on a compliance reason or a regulatory reason or none of that stuff. No marketing. I don't sell anything because it sounds cool on Twitter. If I wanted to do that, I'd get into the UVXY, option space, and I'd have 100,000 followers within a year. Wouldn't make people the right amount of money, and it wouldn't be the right risk tolerance, but it would be very marketable. So that's one reason. Another reason is this is very self-serving, and it's going to sound pretty gauche and stupid, but I probably make more money than 99% of institutional traders out there. So, people can think what they want of that, but it is just the reality that when you're managing a business in the institutional space, when you're a registered advisor, even if you're making, let's say you're managing 100 million in client capital, these days, unless you're phenomenal at what you do, you can't get more than 0.85% of fees past clients, right? So talking about 850, and then you take out all your expenses and your overhead and your employees and the regulatory, the legal fees that you have to pay and taxes and personal expenses, and you get down to a point that people who are managing what seems to be very large amounts of capital, when you really get down to their income, it isn't actually nearly as much as you think. That could be a reason. Another reason is I'm a digital nomad, so I can't settle down in a country and register. I have to do something that's conducive to my lifestyle, and you can't manage money for people that you're not registered in the same jurisdiction as them. So how am I going to move to Dubai and then the next month go to Taiwan and the next month go to Vancouver when I'm registered in Canada? I am a fully certified portfolio manager. I have all the certifications to start my own RIA. I could do that tomorrow if I wanted. I could just register in Canada. But that wouldn't really allow me to duck out and do some traveling, would it? So that's a reason. There's lots of reasons. I should put that video formally together for everybody so they kind of understand where I'm coming from. What's this? You have opened my eyes to a new way of thinking and viewing those who don't want to go to Bill Gates' house. Yeah, that's what I said. Go to Bill Gates' house. I have nothing against Bill Gates, by the way, but it was a funny way of saying it because you want to try to dodge the YouTube algorithm. Yeah, hopefully a few people were like, well, I totally disagree with this one, but I can kind of see it because my cause is this one, and maybe that person doesn't agree with my cause, but I'd sure like a little bit of solidarity from them. As humans in this world, we have to understand it's perfectly rational that me as a person, if I want people to stand up for me, it just goes with the territory that sometimes I have to also stand up for them, even if it's something I don't care about or even if it's something I disagree with. Shocking, I know, but sometimes we do have to show support for things we actually disagree with. Was that awesome quote from this really old movie. I'm a huge movie fan. I've basically seen every movie out there. What was that Michael Douglas movie where he was the president? And anyway, one of the quotes was that free speech is when, and it's not unique to that movie, it just popped in my head, but he said something like, true free speech is standing up for somebody's right to say something that you would spend a lifetime opposing. That's really what we're talking about here. It's not that, hey, I'll only back you if I agree with you. No, it's like, I'm at some point in my life, there's going to be a cause where I want my neighbors to stand next to me. There's going to be that cause. For you, it could be firearms, it could be abortion, it could be, God, I'm going to get demonetized like crazy here. It could be going to Bill Gates' house, could be cyber security, could be all kinds of things, cancel culture. I'm going to want people to have my back. And so I don't want to be that guy that turns around and is looking for his neighbors and everybody's like, dude, you didn't support me when I wanted your help. Why am I going to help you when you want mine? So, yeah. It's just a way of being compassionate to other people we disagree with. What's this? Check out Malachite, probably. Malachite Capital Management Fund. They keep rolling short VIX call in COVID, then blowed up with 1 billion losses, if I remember. Yeah. Well, there were several. Oh, you're talking. Yeah, I know the name. Yeah. Melville. Yeah. Well, there was more. There was many more. There was a lot of blowups that weren't so public. That, yeah, that's kind of what happens. I think you're getting at one of those previous questions where why wouldn't you just kind of roll it out and accept that sometimes you're going to get killed, but most of the time you're going to make that easy money. It's just not an equation you can balance. The punishing days are going to hurt so much worse than 6 months of easy money. It's just, you're not going to be able to balance that equation. Don't pick up pennies in front of the steamroller. These memes and these quotes and these tired old cliche statements like picking up pennies in front of the steamroller, they're not completely without merit. I know people roll their eyes. They're like, oh, again with that cliche statement. It has value in it because it's true. Yeah. What else have we got? I should stop talking now. I've been doing this for a while. I ranted for far too long to the point where somebody was actually asking me, can we get to the volatility stuff already? We don't care about Kamaru Usman and we don't care about Bill Gates' house. Yeah, let's stop the rant right there. Let's pack it up. I'm going to do another one in a week. I'm going to try to do one of these every single week. Hopefully people learned, what do we recap? We've basically targeted based on law of very large numbers, long-term decay factors. We have decided that the VXX, based on historical norms, is going to split on March 24th, 2023 at a price of about $10, and the UVXY will split at 713 on September 19th, 2022. Let's see how close we are to those numbers. Remember, they are only based on long-term decay factors. All we can ever really say is, historically speaking, this is what it looks like. I can't overlay my opinions on this because I don't trade based on my opinions. I trade based on things that can be modeled and quantified in a spreadsheet. And there we go. We're looking at a year to a year and a half, and then we'll go through this reverse split nonsense again. So thanks everybody for watching. It was a weird one today. I assure you, if you're new here, thanks for coming. They're not all like this. I'm not political. I'm not outspoken about public social issues. I'm just using whatever teeny tiny little community I have to remind everybody that we are all just doing the best we can, trying to take care of our family and friends in the best way we know how. Just because somebody disagrees with me doesn't mean they're not also doing their best. So let's be nice to everybody. Let's make it a point to form friendships actively with people we disagree with, just for a few months and see what it feels like. Go out for a drink. Take a coworker to lunch one day that you know you disagree with. You know what you're going to find? That conversation is, in general, pretty pleasant. And you're going to agree with them on 80 or 90% of the main points of life. And yes, you might disagree with a few things, but most of us are very compassionate, well-intent people, and let's be nice to each other. So thanks everybody for watching. See you next week.